This is WealthBT, a podcast of BT correspondents.
Some U.S. stocks have skyrocketed. Do you sometimes kick yourself that you've missed out? The latest darling is Nvidia, which makes chips and processing units to power artificial intelligence, yet another very powerful investment theme. Here's some data that may make you weep, and I preface this by saying that I missed out too, but I'm not weeping. It's this. FAANG stocks are still a big thing, but in returns this year, they've paled beside Nvidia. FAANG spells Facebook, now Meta Platforms, Amazon, Apple, Netflix, and Google. Year-to-date, a Bloomberg index of FAANG stocks has gone up by 29%, and the Magnificent Seven stocks, add in Nvidia and Tesla, have gone up 42%. Nvidia alone has risen by about 143%. That's astonishing. The question many investors ask today is this: is it too late to participate? How should you approach investing in tech stocks? How much of a bet should you take in your portfolio, either in a single stock like Nvidia, where growth expectations are phenomenal, or on tech as a sector? In fact, what's an investment approach that ensures you can participate and you can stick with through time, in strong or weak markets? Welcome to WealthBT, a podcast of BT correspondents. I'm your host, Genevieve Cua, wealth editor of the Business Times. Every week, my colleagues and I break down a business story that matters. My guest in the studio is Dr. Wei Dai, Head of Research and Vice President of Dimensional Fund Advisors. Welcome, Wei. Thank you for sparing some time.
Yeah, thanks for having me.
Let's talk about the tech sector. It's such a powerful theme, and in the past few months, we've seen this outsized rise in big tech stocks, which makes people feel they're missing out. How should individuals approach investing in tech? How much should they invest in the context of their overall portfolio?
Yeah, so the big tech has certainly been a very prominent theme, not just over the past few months, but for over a decade now. Talk about FAANG stocks going to FAANG, Magnificent Seven, now all eyes on Nvidia. I think there's no denial that some of these companies have changed fundamentally how we live and work and organize as a society. And their success as a result is reflected in their stock prices. These are mega cap stocks commanding high valuations. So that's how market works and how capital gets allocated. Should people then be chasing these stocks? You mentioned fear of missing out, right? That FOMO feeling. I think it is very tempting, but that FOMO can get people to focus on the wrong thing, on the shiny objects, and forget about fundamental investing principles. Identifying a good company is not the same as identifying good investments, because these can be great companies you want to work for or buy products from, right? They can run very successful businesses. But then those future expectations are already built into today's prices, today's valuations. And your investment returns depend on what you pay and then what you expect to receive. So all else equal, paying more means lower expected return. And that is very much consistent with our own analysis, looking at, for example, U.S. stocks going back almost 100 years. If you look at those stocks that became, say, the top 10 stocks in the market, on their way there, they had phenomenal returns. That's how they got there in the first place. You're looking at double-digit returns in excess of the market, like what you were referring to. But then once they got there, their subsequent returns were pretty close to the market, or if anything, underperforming the market slightly. And I think that is consistent with the fact that these are mega cap growth companies that should come with lower expected returns. So I think it is very much a good reminder for investors to not extrapolate those past performance into the future. The best way to avoid FOMO is simply to diversify. If you own everything, you cannot miss out. But more seriously, if you think about AI and the impact of technological advances in general, they reach far beyond just chip makers or handful companies. We already saw, for example, even liquid cooling product companies benefiting because those servers can run really hot. But more broadly, Dimensional included lots of companies exploring AI tools to increase efficiency and scalability of their businesses. So in that sense, AI tide, as we say, may lift all boats. Investors don't really need a narrow sector fund or a thematic play in order to benefit, but actually you can be broadly diversified because there will be winners and losers in every sector. So being broadly diversified and not to invest based on subjective views will be a more reliable way. And of course, if you then want to outperform the market, you can then tilt away from mega cap wealthy companies a little bit and tilt towards smaller cap, deeper value, highly profitable stocks. Those are the stocks that research shows that come with higher expected returns.
I like the point you brought out. A good company is not the same as a good investment. So that's worth remembering. Now, today, a big concern that keeps coming up is this concentration risk, that the broad indexes maybe hold too much in tech. Like in the S&P 500, big tech's share is more than 30%, but maybe it's already 35%. And MSCI World is around 25%. What does this mean for investors? And are there risks that arise from this that maybe people may not be fully aware of?
Yeah, absolutely. I've seen the concern around concentration, whether it's about the tech sector as a whole or maybe just about the top holdings, right, in the market being very high. I'm actually going to push back a little bit on that notion that it's a completely new norm that we've never seen before. Now, imagine if I say to you, there's a top-heavy stock market with the largest 10 companies accounting for over a quarter of the market, and the largest one being a tech company, accounting for 6% of the market. That sounds a lot like today's market, yes, right? Because Apple is at 6%.
Yes.
But I was actually referring back to 1967 when IBM represented that 6%. So I think although the concentration level has been creeping up in recent years, it is not the case that we are in a completely new norm that we should suddenly just throw out everything we know about investing. Diversification is definitely very important, which means your concentration risk in individual stocks, in sectors, in countries, those are important to take into account. And I think the level of concentration depends very crucially on the size of your investment universe. People often talk about, say, NASDAQ, very tech heavy. So there, the top 10 holdings may make up almost 60% of the market of that index. And S&P 500, the top 10 holdings hold up now 35%, so a little bit more broadly diversified. And then if you start to add small caps, so in Russell 3000, then that concentration gets down to 30%. And then if you now start to get at developed markets, emerging markets, there are tens of thousands stocks out there. Now your top 10 holdings will make up something like 20 or less than 20%. So I think it is important to go beyond just the tech sector or tech-heavy indices and to go beyond just the large caps. I think there's no better time to be a global investor than today. With the evolution of markets, with the advance of technology, now you can access tens of thousands stocks across 40, 50 countries at very moderate fee. And then earlier, I also talked about tilting towards smaller cap, deeper value, and highly profitable stocks. And that can actually help manage some of the concentration level as well, because the top holdings tend to be mega cap growth companies. When it comes to portfolio design, you might need to think about individual security caps and also think about sector caps. So essentially thinking about how you might want to balance the trade-offs between expected return, diversification, and cost, which requires a lot of implementation expertise. So I think for investors, instead of being carried away by some of the big themes and investing hot tips, actually paying attention to those implementation details is what really matters when it comes to evaluating managers and evaluating strategies.
We've just been speaking with Dr. Wei Dai of Dimensional Fund Advisors. The Federal Reserve has just cut interest rates by 50 basis points. What does this mean for your portfolio? And we'll discuss an evidence-based investment approach that you can stick with in bull and bear markets.
If you've been a fan of the podcast Mark to Market, WealthBT and PropertyBT, they are moving to a new listing, BT Correspondence. Look for episodes every Tuesday from October. All the insights and analysis and market trends, property, wealth, and soon mobility too. Powered by the Business Times journalism of Genevieve Cua, Leslie Yee, Ben Paul, and Darren Wang. Because great reads should be heard. The BT Correspondence Channel. Find BT Correspondence wherever you listen to podcasts.
And now, back to WealthBT, a podcast of BT Correspondence.
Welcome back. Wait, the Fed's move in September to cut rates by 50 basis points is more than some expected. So far, the asset managers and advisors I've spoken to say this. First, that people should begin to move out of cash. And second, it's not too late to get into markets. What do you think this rate reduction means for stocks and bonds and for those saving for retirement? Is there any impact?
Yeah, I actually got that question from my neighbor last weekend when we were both chasing our toddler. And she is a history professor. So I actually complimented her for being so up to date on market news. What I told her, of course, you should read the news to be an informed citizen, but don't use those to inform your investment decisions and your retirement portfolios. These events are so closely watched, so widely anticipated. So the probabilities of different scenarios and the expected outcomes are continuously priced into security prices, stocks, and bonds. So reacting to Fed actions will not really help improve your investment outcomes. So we've done a lot of research, and what you see is that if you plot stock returns against, say, interest rate changes, whether it's Fed fund rate or 10 years, or the level interest rates or the slope of yield curves, you really see just a big cloud of points. There's really not much discernible pattern between the two. That means even with perfect foresight of where rates are going, it's still not going to help you with stock investment. And when it comes to bonds, I think it's natural to think that they should be more closely related to Fed's actions. It's true that Fed controls the Fed fund rate, but what you tend to see is that oftentimes the short end has already moved before the Fed announcements. And also the Fed doesn't control the entire yield curve. We saw the 10-year move up by 5 basis points when the Fed cut by 50. And also there's not just one yield curve, there's multiple yield curves from different currencies, different corporate, different credit qualities. So in the end, all of that is consistent with the decades of academic literature showing that interest rates are largely unpredictable. So what that means is that if you look at today's yield curve, it doesn't tell you much about future rate changes, but it does contain a lot of information about return premiums, meaning that return differences between short versus long end, between lower credit quality versus higher credit quality, between different currencies issuance, thinking Singapore dollars versus USD, Australian dollars, and so on. So that means rather than speculating how rates will impact your investments and thinking where rates are going, you can actually use the current information in real-time yield curves to position the portfolios for higher expected returns on the fixed income side. And I think the last point I will make about investment, because you asked about retirement in particular, it's good to think that there will be many more FOMC meetings. In the future, throughout that journey, there will be many more events happening, and it is going to be a multi-decade journey. And so you need to be able to set up an asset allocation that's suitable for your time horizon, for your risk tolerance, so that your portfolio is set up that you can plan for what can happen instead of just based on predicting what will happen. That will allow you to stay disciplined, stay invested, and also tune out some of the shorter term noises if you think about the grand scheme of investing.
Dimensional Fund Advisors, your firm, it's not that well known in Singapore or in Asia, but it's very big on evidence-based and science in investing. So what exactly does this mean, and how does this make sense?
It is true that we're not that well known. I often joke that we're the largest asset manager that you've never heard of. People are often surprised to hear that we manage close to $1 trillion in Singapore dollar terms, and we pioneered this evidence-based factor investing since 1981. And we have close ties with the brightest minds in financial science, including 5 Nobel laureates.
Yes.
I think it's true that people probably don't think of buying stocks or bonds as a scientific endeavor per se, but I don't think it's an overstatement that financial science has changed the entire investing landscape. The the evolution of investing is quite naturally happening. That's starting from stock picking to indexing, then to systematic active factor-based strategies, which in our mind offers the best of both worlds of active and passive. We're not investing based on subjective views. Our approach is backed by rigorous research, which then translate into multi-factor portfolios that pursue higher expected returns in a broadly diversified, I'm talking about tens of thousands of stocks in our universe, and a risk-controlled and cost-effective manner. This evolution we're seeing is happening at different stages in different markets. We are a global asset manager, and we've been in Singapore for 10 plus years. Asia is probably still in that early part of that journey. We are seeing an ongoing shift in the landscape of the financial industry, that investors are increasingly aware and understanding that difference between short-term speculation and long-term disciplined investment. And as a result, we are seeing more investors embracing this systematic, active way of investing. And we're pretty proud to be part of that transition and being recognized. I know a lot of people are very excited that we're finally our strategies are on CPF, which in our mind fills a very important gap in that market. Because in the end, you want people to be disciplined, to stick with an investment philosophy. And I think our science-based, diversified, low-cost portfolio will help people stay in their seats through the ups and downs so that they can eventually capture their fair share of the market premium, the market return, which historically has been a pretty good place to start, plus a little bit more through our tilt towards those factors.
Mm-hmm. Okay, thank you. Yeah, I think by tracing this history, it may give people more confidence that, with this kind of evidence-based and careful picking of the factors that matter, that they can basically have confidence to invest in regularly.
Yeah, absolutely. Because I think in the investment industry, there's no shortage of, say, people providing you the flavor of the week. But then I think that puts a lot of pressure on investors to think, okay, I now need to rotate from this fund to the other. And all that buying and selling actually oftentimes make investors worse off.
Thank you, Wei, for sharing some time with us. There's a lot to think about.
Yeah, thanks for having me.
Nvidia alone has risen by about 143%. That's astonishing. If you're investing for a long-term goal like retirement, what you want is that your capital grows steadily through time. You want a portfolio where you profit as markets rise, and at the same time, it's so diversified that it cushions your downside. Applying factors over a broad index sounds logical because this may add value over time. Plus, of course, watch your costs because it's simple math. The lower your fund's cost, the greater your net return. I hope this helps in your investment journey. BT Correspondence will be back in a fortnight with an all-new episode on transport, so do check it out. If you have any thoughts or questions about the show, email us btpodcasts@sph.com.sg. I'm Genevieve Cua, and as always, thank you for listening.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.